Welcome to episode 135 of the Oklahoma Real Estate Show. On today's show, Lane Kawaoka, he is an investor and syndicator and licensed civil engineer. Lane has a master's degree in civil engineering with an emphasis in construction management and a bachelor's in industrial engineering, both from the University of Washington in Seattle. He currently owns 65 apartment buildings, 2 manufactured home developments, a hotel, an assisted living facility, and that all's totaling about 10,000 units. Lane's coming on the show today to share a little bit about what he's learned over the years and maybe pass on some tips and tricks for you folks listening today. Lane, welcome to the show.
Hey, thanks for having me, Landon. Aloha, everybody.
Yes, Lane, you're coming out of Hawaii today.
Yeah, yeah,
Yeah, so you're what, 4 hours behind the Midwest? Does that sound right?
yeah, or three, one of the
Three?
two. Daylight savings just hit, so we don't do that out here. But yeah,
That's right.
yeah,
Yeah,
we're always behind you guys.
yeah, there you go. So kind of take us in. So you kind of started small and then just exploded, and now, I mean, kind of give us the 10,000 view, and then let's get into kind of the day to day on what you're learning now, what 2023 has looked like for you, and then what's 2024 going to look like for you.
Yeah, I mean, we started, right, was just a passive investor working my engineering job. Graduated college back in 2007, bought the first house to rent out in Seattle, 2009. And through this time, just was saving up my money to put 20% down payments. Never did any of the wholesaling stuff. Never did any of the fixer flips. Just started buying rental properties. And then, as everybody knows, Seattle is a very high priced area, such as California. The numbers just don't work. I was lucky enough to kind of start at the right time, but I eventually gravitated to a portfolio of all these turnkey rentals, which I'm sure a lot of the listeners kind of have heard of. So I picked up 11 of those. So 5 in Atlanta, 4 in Birmingham, 1 in Pennsylvania, and then 1 in Indianapolis to start out. So I had 11 of them. And that took us up to about 2015. So from 2009 to
Gotcha.
2015, people don't realize how slow this is. This is not the get rich quick scheme. But
Right.
then,
Well, and it's
started.
important to note too, in 2015, most MLSs allowed people to put package deals on the MLS. So you could search for the keyword as a realtor, package deal or multiple property, and you could actually list them. And then the appraisers all fought over making that not happen because it was messing with the market. And so, but yeah, 2015, you could find package deals. Just
Yeah, well,
Google
I
it.
was buying them by themselves. I bought them all individually
Oh, wow.
back then.
Okay.
Um, because that was just what I wanted to. I wanted to separate different
Mhm.
geographic areas, not to be all in one place, right?
How many
Just
houses did you have per market though at that point?
5 in Atlanta, 4 in Birmingham, and 1 in Pennsylvania, 1 in Indy. So I was kind of on this strict of like, get 20, 30 houses, right? And maybe 6 or 7 in each of these 4 or 5 markets. But I'll tell people rental properties are a great way to get started. That's for sure, right? Help me get to accredited investor status. However, they're just not scalable after a certain point. And I definitely started to see that around 11 rental properties. To give people what a sense that how it is, I had professional property management, right? I know you guys do that. I mean, you guys are godsend, especially for those out of state investors. And that's what I was at the time. But even with 11 rentals, that was a few $1,000s of passive cash flow a month. But you need $10,000, $15,000 at least, right, to retire. And that's like 30, 40 houses. But just with 11, maybe an eviction or two every year, some kind of big catastrophe that happens every quarter. Of course, Landon's guys are, taking care of all those headaches for me. But at some point, it does become a bit of a headache for the landlord or the owner to kind of bird dog the property manager to do all this stuff. And mind you, I had 4 geographic areas that I had to work with, 4 different property managers. So I started to realize, this is becoming a bit of a pain in the butt to manage all these properties remotely. And that was kind of where I started to interact with other accredited investors and started to learn about syndications and private placements and being a passive investor in, more commercial assets, right? Bigger deals.
Okay, so that brings us to what, 2017?
Yeah, about 2015, 2016, I kind of knew the writing was on the wall and I started to search for, what does a guy do when he owns rental properties? He goes looks for something bigger that's an apartment, right? So we get into the multifamily apartment investing world and, kind of started to learn about that, started to realize that, they are a lot more scalable when you're able to get a, 60 unit. Now you're able to have a leasing agent there on site at the property all the time. But once you get about 100, 150 units, now you're getting a lot of great economies of scale. No longer are you getting gouged by plumbers who come on there and, you have those people on salary and staff. You have HVAC people or people who are HVAC trained to knock out those little issues here and there. And you get a lot of these economies of scale. And instead of a house, which is very unique asset, they're all different. Apartments for the most part are boxes, right? Interior boxes that you're renting out.
So
Yeah.
keep going. So
And
you
I'll,
so you got this first one, 65 units. I'm assuming you sold all your single family. Did you sell all the single family and like 1031 into a multi-unit? How did that
um,
happen?
no, I mean, I had money to go into as a deal as a passive investor. Normally it takes 50 grand and I just wanted to try it out, right? Because it was a big difference when I was kind of the landlord myself operating the asset. And then when you give up control, right, as a passive investor. The nice thing is you don't get the debt in your own personal name and you don't really have to do anything, but it is a big step, right? Signing all these PPM documents and then kind of giving up control, right, and oversight. So there
Mhm.
has to be a lot of trust, with the people that you're working with. But I had the ability to invest in some deals, figure out who were the right people to work with. And then around 2016, 17, I started to divest my single family homes, which luckily had appreciated and then started
Mhm.
to go all into a more of a securitized kind of form with syndications and got away from all direct ownership of rental properties.
And at this point, you're still W-2 or still doing your primary job. And then this is money that you like are self-directing in an IRA or what? What were you? I
Most of
mean,
this
what
was
was the
cash. I mean,
headspace there?
I was in my 30s, right? And what I tell most of my investors these days is like, for most people, unless you make over $360,000 adjusted gross income and you're older, these retirement accounts don't really make sense to me because you're just delaying taxes and you want to pay your taxes now while your tax bracket is lower. Well, everybody's tax brackets is lower, right? I think taxes will go up in the future and you want to invest in these types of arrangements where you're getting
That's
passive
the only
losses.
way they've gone is up. So I mean,
Yeah, I mean,
yeah,
essentially putting your money in
right,
in the
smart.
401k or these deferred payment plans is like giving the IRS a blank check to tax you on whatever the heck they want you in the future.
Nice. Good. That's an
S-
interesting way of thinking of it. Yeah.
I mean, unless you're older and you're right on the doorstep of the retirement age where you don't get hit up with a 10% penalty, it just makes so much more sense to just pay the
Right.
piper, take it out now. And when I started to interact with other accredited investors and in these syndicated deals, you can do what's called a cost segregation, where when I think a lot of listeners know you can deduct 1/27th of the value of the property of the
Right. Per year.
improvement
Sure.
portion every year as depreciation, which is great,
Mhm.
but it's
Well,
super
not
slow.
just you can, you have to. You have to. A lot of people think, oh, well, I'm not going to take the depreciation. Well, you will, because when you sell it, they're going to recapture it whether you took it or not.
Yeah.
Like that's the caveat to depreciation. The IRS takes it. I mean, you're forced to take it.
Yeah, no,
So
you're
let's
you're
not forget that.
exactly right. I mean, whether you take it or not, but I mean, you can with these larger syndicated deals, a cost segregation can be done. Typically costs like $5,000, $10,000 to do that, but on a large 100, 200 unit apartment, what's 8 grand? That's nothing.
Mhm.
And with that, you can take I've seen 1/3 of the property written off all in the first year. What this does individually for our passive investors is makes a huge amount of passive losses the first year, maybe 10, 20 times the amount you would have gotten otherwise. And now
Interesting.
this creates a whole bunch of negative passive losses, which you can go and attack other passive income on your sheet. But if you're doing rep status, real estate professional status, now attack
Mhm.
other income that you have on there, maybe from your day job
Whi- Which
potentially.
which could be hard to prove for a lot of folks. That's a hard one. That's getting more and more hard with the hour requirements and stuff. So let's just kind of summarize real quick for those that may just say like, man, I don't even know what you're talking about. So what I think you're talking about is a group of folks getting together, pooling their money, and purchasing a multifamily apartment complex. We're talking 100 unit, 200 unit, 300 unit, 500 unit, 1,000 unit, and all pulling their money to buy it with a plan in place that they're either going to sell at a very precise time or at a precise income or whatever. And then they're all sharing the tax benefits and the expenses along the way of that purchase. And what he's saying is when you buy $100 million apartment complex, let's say, you're dividing that by 27 and a half. And then each member, depending on what share they have, is then writing off that depreciation on each year's taxes. And the good thing about it is you never had to spend any money to get that expense, right? Depreciation is something that requires no spending. As business owners, we got to go buy a golf cart, right, to write it off for the golf club, right? No, nothing needs to be bought here for depreciation. So,
Yeah, it's actually better
did I
than
say
that.
that right?
It's not
Yeah.
1/27th, but it's 1/3 the first year.
Wow.
So 10 times, 15 times, something like that the first year. Yeah. And I mean, you could cost seg your little single family home, it just won't be cost effective, right? On that scale. But
Great.
this is the bonus depreciation, and bonus depreciation is going away over these next few years, but this
Mhm.
also brings in the more aggressive depreciation. Totally legal, right? But when you have a larger property, you can now itemize the different dates of the asset.
And you
Super
say,
kind of
so for they're
technical, but
listening, but they're what type of income range benefits from this? You said 360, but you were talking about IRA. Like if you make less than 360, you should probably not be investing in like your long-term retirement accounts. Kind of run me through that again as far as like where are we talking?
yes,
What kind of
yeah.
tax burden or liability should you have to start thinking this way?
Well, everybody should, right? Because if you're using Roth IRAs accounts for deferring your taxes, that's like playing checkers when the wealthy are playing chess. What I'm talking about is your adjusted gross income, driving that down based off of you have passive income. You can knock that out with passive losses. Or I would disagree with what you said earlier. It's rep status is something everybody needs to be looking at. If not, it's kind of going behind your back, and you're probably missing out on a big opportunity there. And it would likely, I would say 95% of our investors change their CPA because most of the CPAs just don't understand this stuff. Now, that said,
Mhm.
I'm not a CPA, right?
Right,
That
right,
then again, I don't have a job like some of them, right? But
sure.
it's important to kind of work with the right CPAs, right? Which kind of we
So
found out there.
obviously, if you took the standard deduction and you take the standard deduction, right? Yeah, that this is not for you. But if your tax obligations is like what would we say, 50,000 and greater per year? That's kind of who this falls into. What I mean,
Yeah, I
get
mean,
kind of
I
let's
would say
quantify this.
if you're probably over a couple $100,000, probably would make sense the brain damage to get really start to educate yourself on this. Or if not, at some point your income will increase, right, in the
Mhm.
future.
Okay, so let's fast forward. Interest rates are climbing. We're now in a world where syndications may not work, right? It might not come together unless it's maybe an all cash syndication. Is that what you guys are able to pull off, or are you syndicating and still leveraging when you purchase these multifamilies?
Well, syndication is just, kind of going back on what it is, right? Like it's a mechanism for pooling investor capital together to now
Mhm.
go after a asset that is less heavily competed against, right? I mean, this is the whole point of why we syndicate, why we go to 100, 200 unit apartment complexes or whatever, where we do a big, non-real estate investment, right? Because we want to get away from the small players buying $1 million or less or $5 million or less properties, the duplex,
Mhm.
triplexes, quads, 16 units, right? It's very competitive in those spaces. What we want to do is rise above that crowd, get around the crowdiness, and get to there where there's a little bit less competition. We can syndicate anything. It could be apartments, self-storage. It could be a bunch of pizza franchises. It could be a bunch of buying a bunch of engineering firms, professional services, or law firms. You can syndicate anything. So right now, with interest rates high, real estate is heavily impacted by real estate. Like right now, like I haven't really bought anything since last summer because interest rates are high per the Fed, but really what it is, it's the loan to values are very low. There used to be I could get 70% loan to value, but when loan to values are 50%, like how they are now, I have to bring more capital to the table. Even with like prices went down like 30% commercial real estate for the most part, right? Even with price discounts, even if I can get a 30-40% price discount, I still have to bring more to the table because the loan to value requirements require me to do that. And because I'm at the end of the the deal kind of guy, right? What are the numbers? What are my returns? A lot of that is heavily impacted based on how much capital, right? My initial investment, right? So that's why we haven't really been doing real estate normally as we've done as value add. Today we kind of focus on development because it kind of is a little bit insulated by a lot that's happening lately in real estate world, and preferred equity is another option where we're kind of just lending out as debt, and then possibly even getting outside of real estate, right? We're kind of doing some ATM machines. I'm possibly looking at even some venture capital in the SaaS business space or product space. It's again, it's like the evolution of an investor, right? Like I think real estate's great in an environment of interest rates being low, right? But right now, if you can't get good debt, it kind of takes that
Well,
away.
you got, yeah, right. The ability to leverage is really what created the real estate market we know of today. Okay, so let's kind of bore down, because this is a real estate show. I mean, we could get off into all types of exciting things, and I love to do that with friends around the fire and things. But let's talk about those that already have maybe a multifamily, maybe they got a duplex, maybe they got a portfolio of 80 units, and they're like, well, crap, I was going to expand, I was going to buy more. And now I kind of, like you said, you haven't bought anything for a year. A lot of us are like that, where, I mean, over a decade in this industry, when I buy it, I know exactly what needs to trigger, and I will wait until that triggers. And when it triggers, great. When it doesn't, it doesn't. And a lot of us are that way. And so now we've got the portfolios, and we're like, we're going to tinker with them, right? We call it tinkering, portfolio tinkering. What are things that you maybe have heard from friends, or that you've tried, or that you're kind of hearing on the street to kind of prepare us to have better returns in 2024 with our existing portfolios?
Yeah, I mean it's the simple like kind of hedge the bush a little bit, right? Like look at your portfolio. What are the 20% worst ones or the ones with maturing debt? You may have to take a loss, but just cut it off at this point, right? That may be the best situation. Right now, I mean, I don't have a crystal ball, but if people go to Chatham Financial, the people who sell all the interest rate caps, that's our best guess. That's kind of the Vegas odds right now. And they're saying that interest rates will probably peak Q1 of next year. And it won't go down right away, but hopefully by the end of the year, it starts to trickle down. But it won't go under 4% for quite some time. So with that in mind, right, like, can you wait that long? Can you wait to survive till 2026 on where you're at? And if not, the decision may be to slowly prune off properties than to maybe be a net seller in that. That said, prices are really low right now, or at least in the commercial world, right? Because there's not many buyers out there because most buyers need good debt, which is not available.
Mm. It's a really good
It's
point. So
kind of a
let's kind of
logjam, right?
right. It is a log jam, but for those that did make good decisions over the last 3, 4, 5 years, and I met with one today that I mean, just the amount of wealth that was generated in the last few years is insane. And these folks, by all means, no, but a lot of them are not hurting, right? Like it's wonderful, but what they want to do is be able to kind of be ready for that 2024 2025, where what we keep saying in the industry is a lot of the younger kids are saying to hell with buying, right? Like they're not even thinking of buying anymore. It's all about what rental can I get and how can I rent and what can I do with my rental. And even manufacturers coming out with these new things that are stickers on backsplash. You rent a property, you don't like the backsplash, you can put a like a wallpaper kind of thing on your kitchen backsplash to customize it while you're renting, right? So like we're kind of gearing up to have this new movement where the young generation just kind of stops looking forward to buying their own home and is more what we call like the more portable, where they just rent and then that's all about traveling and experiences in life. And so I think we've really tried to kind of understand that and really say, what does that mean and how do we sales pitch the new tenants now? And we're using words like your space, right? You get your space in life. I know MySpace is doing the metaverse, where instead of renovating your home, right, you just buy a headset to make your home look nicer, right? So, I mean, that's kind of crazy to think about, but I think it's really where a lot of us are realizing, how do we serve the consumer? And the consumer in our industry, right, is the next generation that's renting, right? What are they looking for? What questions are they asking our intake staff when they're saying, hey, does it have this? How much is my pet deposit? I don't know if you've seen this, but there's a 3 times increase in emotional support animal documentation. I mean, it's exploded since Biden has allowed that to basically be treated like a service animal. So before, we used to be able to add on like $20 a month pet fee, 25, something like that, per pet. And, these folks have 2, maybe 3 pets. So that's $60 per unit coming in every single month. Well, now they go and they get a letter from their doctor, which takes nothing. It's $99 online in some cases. And now we can't by law charge a pet fee anymore, or even a pet deposit, right? So that's how kind of the landscape has been changing. Is it scary? Sometimes, yeah, but it's also exciting because we have big corporations with like 30,000 rentals, like just this massive, huge, like they tunnel vision, if you will. And then the smaller kind of property owners, they're pivoting, right, in a lot of different ways. And so we're even rolling out, we're the first company in Oklahoma to offer Bitcoin payments for tenants and owners, right? We just flip us over into a monthly fee where you just pay a monthly fee for us managing. And then all of a sudden, the tenant is able to send a wallet transfer directly to your wallet. And you just let us know if that doesn't happen. And we go in and do what we got to do. So there's a lot of things, I think, happening now in the rental space that are really exciting to me. It feels like kind of the wild, wild west again. And I just wanted to hear, have you heard any of that on your side? I mean, I know you're kind of like way up here, and 40,000 feet up there, but are you hearing any outside the box ideas from your property managers or from these leasing agents, or just even people pitching you on new returns? Anything coming on your side in that?
Yeah, I mean, we build, right? We build workforce housing, so you're $1.10, $1.30 a square foot type of properties. I mean, definitely the one trend is people don't really need big spaces anymore. They would much rather have, my new build at 900 square feet, 1 bedroom, than a 1,200, 1,400 square foot house that's old, that's 50 years old. They would rather have new and small than old and large. I think that is definitely a trend. And like you kind of said, it may not be huge, but they put their stupid glasses on, their lenses, their Apple Pros, then they don't, which cost them 2 months of rent, maybe, then it
Right.
doesn't matter, right?
Exactly.
I mean, that's definitely a trend. I mean, long term, the fundamentals haven't changed. The population is growing, especially the lower middle class. And that's kind of what we invest in, right? We don't build luxury apartments. We are more for the people making 50 to $70,000 a year, the young professional. And then of course we have our class B assets and some class C, right? So I mean, there a population that's, growing, a lot of immigrants coming in. It's always that lower middle class that I think is the underserved population that we kind of focus in on.
What now? So there's two main ways to kind of get occupancies filled. And this is something that when we look at like buying a large portfolio, that a lot of people don't drill down into, and I feel like it gets missed. And that is, let's look at some of the applications to try to understand how they were able to fill that vacancy at that price, right? Because I'll have some property managers or some portfolios come in and it'll say, well, we're 100% occupancy at really good market value, like up the top market value. But then when I drill down, I'll see, well, they were accepting 575 credit scores, right? Or they were waiving deposits, or they were doing 6-month leases, right? And so then we get, okay, well, you're at $1,200 a month rent, or whatever that nice, $1,900 a month rent, but really, what did you trade to get that, right? So I feel like that discussion really needs to be kind of on the table now when we're trying to decide, like, okay, portfolio evaluating, what's it full of and what does it take to keep it that full, and like, who is our end consumer? When we look at multifamily, a lot of times people forget that the allure of multifamily is trying to find a tenant that has a psychology of wanting to live in a community that's tight, that's small. Perhaps it's someone that likes the security of having a lot of people around, or they like the pool, right? The amenities, the gymnasium that's there. They can cancel their gym membership and they can go right on site here. And those things, when you're transitioning from single family home directly into multifamily, big housing, you might miss that, right? Like that's a subtle thing. Like, for example, we just took over a new apartment complex, and and a lot of times, like, I'm in duplexes a lot, I'm in single family homes. And when I hear tenants call in and they're saying, they want to speak to a manager, right? And I'm on the line and they're saying things like, no one else in the complex is doing this, right? The bandwagon theory, like those are things that if you're not used to that, it'll catch you off guard, because a tenant in a single family doesn't say the words, well, no one else on my street is doing that, right? Like, it's not, they don't say that, like, right? But in an apartment complex, they are. Hey, I'm not, my rent's higher than everyone else's next to me, or, no one else has to park their car here. So very interesting metrics. I kind of love that about multifamily, where it is a different psychology. It's like a beehive kind of thing. And I think if you can really drill down on that, there's a lot of outside the box ideas that I think would really capitalize your investments, if you could just really, sit down with the property managers, listen to what they're saying, and then throw kind of you're an engineer, for example, just all the thoughts of, how do we make somebody's life a little bit easier, and what are their pain points? And also, one more thing on that note, if you eliminate all the pain points, and this is what we ran into with yard size, like we increased some yard size on another project, and we actually lost tenant retention because it was a little bit too much, right? So, like you said before, they would rather have newer stuff in a smaller place. You really got to understand who your end consumer is, because if you go in and you value add the wrong things, now you've actually limited yourself in the future. So you really got to ask those questions and then look between the lines of what the person's really asking for. So, all right, that's my rant.
Yeah, I mean,
Anyways,
I would
Yeah,
say like
jump in here.
from apartment perspective,
Hmm.
I mean, going back to like the numbers, and you can kind of see from like if you spend X amount on marketing from the normal channels, this is what's nice about apartment investing. There really isn't too much emotion to it. It's very institutional system, right? Getting leads, people apply, they go to the website, they come around, they apply to these marketing channels. You have X amount of people that come in and apply, and then from there you see who's qualified, right? Like we'll typically have commercial property managers vet these people, and it's very standardized. So you can see from the numbers coming in, and you can do this apartments because in a way they're all renting the similar product, where houses are completely different, right? You're going to have 2 people put in applications for this one, 7 for this one. It's all over the place, just not like a steady state system. But for apartments, it's pretty much, that they're pretty much looking maybe a studio, maybe one bedroom, but they're pretty much all the same product at different price points. So you can kind of tell based from an analytics standpoint, all right, if I'm getting 50% of my tenants who can't even freaking pass the income test, what is that telling us about either our marketing channel, or maybe we're just doing a downward spiral and our rents are too low and we're just attracting the wrong kind of people and it's a race to the bottom, right? Some people think that it's like, well, if your occupancy is a little low, then just drop the price. Yeah, that makes sense, right? But there comes a point where if you drop the price, now you start to attract some of the riffraff that shouldn't be living there in the first place, and you're just going to drop the price. Where in most cases, what we found, it's you keep it the price, the market price, and you just got to hold the fort and wait until you get the right people. And your occupancy will not grow 5%, 10% a month, but it'll eventually get there. And what you don't want is all these bad tenants. Typically, when we take over a property, we're taking over bad deadbeat tenants from the last owner. That's just part of the deal, right? Like, once you're selling something, you kind of don't really care and you put anybody and warm bodies in place. But at that point, a lot of these people were put in who are less than, ideal, right? And you can kind of see that as you start to go through that first year of, the regime change, where higher evictions, these are kind of the deadbeats that trash the properties on their way out. That happens more and more when you start to drop the rents more than you need to.
Wow, good stuff. I think that is the differing line to where, I mean, I think you just explained to us all how you made the decision, what, almost 10 years ago now? Well, I guess that would be 7 years ago now, to say, I want out of the day-to-day grit and I want to get into more of a supervisor role of my investments and moving things. And you just explained that very, very good with that answer there. Lane, how can folks get a hold of you? What is our, let them know where they can kind of learn more about you and what you're doing.
Yeah, if they're a credit investor and they're looking to learn more about these tax strategies, infinite banking, and investing in syndications and private placements, they can go to the Wealth Elevator. We have the podcast. The website is thewealthelevator.com. And if they got any particular questions, how do you get started in this world of investing as a passive investor, they can go to Lane at thewealthelevator.com. Shoot me an email.
Well, Lane, thanks for coming on the show today.
If you're thinking it's time to buy or sell a home in Central Oklahoma, why not work with a broker you already know and trust? The Oklahoma Real Estate Show was created by real estate broker Landon Whitt to help you succeed. It's an award-winning, full-service, licensed real estate brokerage and property management service serving Central Oklahoma. You know that finding the right team in real estate is critical. The Oklahoma Real Estate Show is your boots on the ground with decades of combined experience and most of the team you already know and trust. What are you waiting for? Get started now at oklahomarealestateshow.com. That's oklahomarealestateshow.com.